Good morning, everyone. Welcome to this Coface webinar. It's a pleasure to be able to share with you a few insights into what we believe will make 2021. If we had taken a survey at this point in time last year, I guess a few of you would have guessed that negotiations over Brexit would not be finished 5 weeks before the end of the transition period, but very few of you would have forecast the kind of environment we are in. And to be fair, today we're not going to draw you in forecasts and tell you whether we're going to grow by 5 or 7 or 3%, and that's not the purpose of it. I think forecasting has become really a tough exercise. But what we want to do is share with you some of the insights which we have into the business, and to do so particularly around 3 themes. The first one, to look at the corporate risk and what we can infer from the current environment for 2021, and John Nicholas, our underwriting director, will guide you into this. From there, we'll move into the impact of recent legislation or insolvency laws and how much they can affect you or affect your clients. Hans Meijer, who is the director for information, claims and collections, will guide you through these measures and their impact for all of you. And from there, we would like to highlight one aspect which is very often forgotten, although from time to time there are press articles about that, which is fraud. And fraud has been massively more prevalent in recent times because of the way we work, because of the way we organize ourselves, because of internet connections as opposed to physical connections. And Andrew Share will tell you a bit about our experience, or some tips also to combat and avoid fraud. Andrew is our commercial director, but besides being our commercial director, he's also our chief operating officer, and is responsible for monitoring fraud for Coface UK and Ireland. So he's very well qualified to lead you through this. So we will have the possibility, of course, to take questions. You have a chat from which you can raise questions, and we can take questions just after each speaker has gone through his presentation, or at the end, as you like it. And with this, John, maybe you can tell us what you see for 2021.
Yes, thank you. Thank you very much, Frédéric. I hope everyone can hear me, and welcome indeed to this webinar. Yeah, pretty much as Frédéric was saying at the start of the year, most of us thought this would be that the biggest challenge that would face the UK economy in 2020 would be Brexit, and specifically whether a free trade agreement could be achieved before the transition period expired. While that remains an important issue for several sectors, for example, agri-foods and automotive, the incremental impact on GDP, probably, should a deal not be agreed, is expected to be more modest than originally considered when one considers, just the severity of the contraction caused by COVID. So if I, hopefully I've got the slides, and you can see this. As I say, we're not going to dwell too much on the forecasts, but these graphs illustrate just how severe the global recession is expected to be this year. So effectively globally negative growth of minus 4.8%, which is worse than during the financial crisis, although a decent rebound is projected for 2021. But as you can see from the graph on the right, this is driven mostly by China, and it's the BRICS that are generally suffering less than some of the key European markets across this 2-year period. So if we focus on the UK, GDP, for example, at the end of the third quarter, remained nearly 10% below its level at the end of 2019. And because of the lockdown measures that have been implemented so far this quarter, we're still, at this stage forecasting a full year contraction of 11.4. So even with a 7% growth of GDP next year, the net contraction over the 2 years would be 4.4%, which is still pretty sizable. So turning to this slide, you sort of think it's a little counterintuitive, really. I mean, despite this severe demand shock and the resultant, rapid contraction of the economy, the actual number of corporate defaults and insolvencies, more specifically, have dropped significantly year on year. And these are similar trends which are evident in many other countries. So this gives rise to this term, if you like, that's been coined of zombie economy. So despite this huge, as I said, demand and supply shock to the global economy due to the measures taken to mitigate the pandemic, there's actually relatively few companies are yet showing the actual signs of distress. And this isn't just in the UK, this is a sort of a globally observed phenomenon. So over the past decade, many inherently weak businesses have survived since the last crisis, which is the financial crisis, largely on the back of economic growth and cheap finance. And this pandemic has meant these companies will be joined by many more, particularly in some vulnerable sectors where business models may no longer be viable, not just in the short term, but even longer term, where there's been, say, for example, a permanent shift in consumer spending habits. So the obvious examples would be, hospitality, travel and retail. And many companies, continue to burn cash, and as a result, they've become more financially leveraged as they sought other sources of funds. And only a few of those sort of much larger corporates, a good example would be something like Rolls-Royce, have been able to raise additional equity as part of their efforts to source new funds. So the main concern is that there's that the unprecedented level of state intervention through monetary stimulus and various other forms of direct support, such as tax deferrals and furlough schemes, are actually masking the true impact of the economic contraction. And this is considered the main factor behind the relatively low corporate failure rates, but it's further diluted by temporary changes to the legal framework for insolvencies, for example, and an area that Hans will no doubt be able to expand on in his presentation. And this is also consistent with Coface's own experience. So it's not just the sort of statutory data, but when we look at our claims experience, where really in the last few months it's been a benign environment for claims, as I will show you on this next slide. So this basically contrasts the evolution of claims relating to UK debtors. This is across the whole of Coface Group, across some selected more sensitive areas, if you like. So as you can see, if you look towards the more recent trajectory, there's clearly a slight tailing off of reportable events over the past couple of quarters. And the two exceptions which I'll highlight really are where they're still on an upward trajectory, really is retail, but not so steep, but obviously to a much greater extent, and that's TLE, which is transport, leisure and entertainment, which I guess is not entirely unexpected, really. So again, coming back to the business insolvencies, once support mechanisms are progressively scaled back or removed, weaker companies will be left exposed. They've got poorer cash flows available to meet these potentially greater financial obligations. So while the timing of corporate defaults has somewhat been pushed back from expectations that we had earlier in the year, we nevertheless still expect and anticipate global insolvency volumes to be around about a third higher by the end of next year. And the UK specific projection is basically the same. So it could be that our claims department is going to be even busier next year. Of course, I should caveat, and Frédéric mentioned it during his introduction. When we're looking at forecast projections, they should come with a caveat. These are our, if you like, best guesstimates of our economics department, but there are a lot of variables at play. We've got no visibility, for example, regarding each country's future level of state support. So, and so much depends on how long and how effective such support will remain in place. And of course, there's another dimension is, as we're all hearing at the moment, there's a number of vaccines coming to the market. And so, if high efficacy vaccines are rapidly administered throughout the population and getting the virus under control, this could yet have a positive influence on the consumer sentiment, which of course will then have a knock-on effect within the broader economy. So, I mean, there are challenges there. I mean, underwriting, obviously, Coface, and it wouldn't be any different to other insurers. We we have, with all this background in mind, it's probably one of the trickier periods we've had for underwriters to evaluate credit risk. Assessing a company's liquidity and overall creditworthiness based on historic accounting data, has never been ideal, but it's rarely been more difficult, frankly, because of the huge impact that this pandemic and the measures taken to try and control it have had on cash flows and business models themselves, which have been caused by the reaction to the virus. And furthermore, accounts at Companies House are becoming very dated due to the extended filing permissions. So, my team are having, trying to make decisions, for example, on December 2018 data, which is very aged, particularly when you consider the seismic change to the economy, in the last sort of few months. So information partners are the starting point, but for the reasons already mentioned, credit agency ratings could be rather misleading. So it's increasingly important to enhance the credit risk appraisal with up-to-date proprietary data. So our analysts, working under Hans's team and my underwriters proactively reach out to buyers, obtaining up-to-date management accounts and cash flow projections, for example, but also to really ascertain how the buyer's management has reacted to the crisis in terms of have they been right-sizing the business, or have they refocused their operations, created contingency funding, and a myriad of other considerations. And of course, on top of that, we do of course still have that uncertainty surrounding Brexit to add into the mix. So it's going to be interesting how that evolves over the coming weeks. And I think really that summarises in short where we are at the moment. So hopefully you found that useful. And unless there are any specific questions, I will hand over to Hans.
So as a reminder, you can raise questions through the chat. Do not hesitate to do so, even during the presentation. Before you pass over to Hans, John, two questions, if I may. The first one is, can you clarify a bit how you see Brexit now versus 18 months ago, for instance? What has changed possibly? And the second question is, assume, as you said, that the vaccine is found or rolled out properly across the country rapidly, recoveries ensues, which is very good. What are the risks of a steep recovery or of corporate risks in a steep recovery environment?
Yes, okay. So turning to sorry, the first point was sorry, Frédéric.
Brexit. What has changed between now and 18 months ago?
I think there are a number of factors. I think there are a number of mitigating factors surrounding Brexit and how companies have adapted to it, or what sort of impact it's had. When you consider the referendum was 4 years ago and counting already, a lot of, if you like, the impact in terms of confidence, not just consumer confidence, but business confidence, has been felt within the economy to a degree. It would have slowed because there has been less business investment, for example. So there are other factors which mitigate it. For example, companies, I think where you compared with the original planned Brexit date, or it was March of 2019, there were probably fewer companies that were prepared for it. I think that the fact there's been another getting on for 20 months of preparation time would mean that certainly not all of them are going to be prepared. So I think there's definitely will be some that have had their heads in the sand, but certainly more so. And also other factors. Obviously, one of the risk factors associated with Brexit is the devaluation of sterling, but obviously it's quite weak, and there's obviously some of the downsides probably being removed from there as well. So I think clearly there are risks associated, and they will impact some businesses more than others. There would be inevitably disruption at the ports, for example, could affect supply chains. But I think, contrary to perhaps what some feared, a couple of years ago, of more of a sort of a cliff edge type impact, I would expect it to be more muted, and particularly given, as I said, put into the overall context of what's happening in the economy. Turning to your the second part of your question about should there be a rapid recovery and what sort of impact that would have on some of these vulnerable companies. Yeah, I think there is a risk there, as I mentioned, that a lot of them would have seen a big change in their in their financial condition, and of course the banks, for example, will also be monitoring that as well. And it could be, for example, that their facilities. I mean, we know about Corona's business interruption loans, etc., but it could be that the facilities available not just necessarily just from banks, but other funders have been tightened up a bit and perhaps don't give them that sort of flexibility. Cash would have also been absorbed by them making, say, one-off, maybe associated with one-off costs in terms of adjusting their business model. So they might have had support through furlough, but then they may ultimately have cost of redundancies in some cases. They may have costs, obviously making their facilities, COVID secure, and other, as I say, exceptional costs relating to right sizing the business, which of course would have consumed cash as well. Impact, as they grow rapidly and trying to buying. So, is their level of trade credit still the same to enable them to, have sufficient liquidity and the working capital to grow the business if there is a fast recovery. So there are a number of factors, and again, it probably highlights just what I mentioned on that last slide there about how critical it is to try and bring our information as up to date as possible, get that that clarity as far as possible around particularly some of the buyers in the more vulnerable sectors, and and ultimately that will help us give us the best steer to our clients and other stakeholders as well about where the risks lie.
Thank you, John. We have a number of questions which have come up. I will pull two of them together. First question is, how do you expect repayment of government debt will impact business in the future? And the second one, I know it's not exactly the same, but it's related to some extent. Does Coface use a special risk management department to handle companies in financial distress? And in some ways, a lot of companies may find themselves in financial distress if they have to repay government loans or debt. So can you take the first and the second question together, please?
Sorry, I should have made a note of that. The second one, in terms of the...
Do we use a special risk department, or how do we manage companies which are in financial distress?
Yeah, that's
and where we do have exposure.
Yeah, I mean, and as far as that point is concerned, we don't have a specific department for if you like our intensive care sort of cases. They are sort of managed within the underwriting department, but in collaboration with our enhanced information department. So although we don't have a department per se, we do have a specific process in place, which we call our sensitive, effectively like a sensitive risk committee, which obviously you're familiar with, Frédéric, because it's myself, Frédéric, and Hans, who will sit with two of our senior underwriters and regularly review our larger exposures on more marginal risks.
And do you expect government debt to be repaid? And how
yeah,
do you see that developing effectively?
Yeah, I think it probably comes back to the point I made about, at this stage, not having the visibility about how long government support will remain in place and, how effective it will be. I think the same would apply to, who knows what forgiveness they may give in terms of loans that have been taken out where companies are struggling to repay. Yeah, I mean, given that based on their most recent track record, you just said, I mean, the amount of funding, the amount of support that's been put into the economy, and this is basically a personal view, it would seem odd if they suddenly, were to just a year down the line, for example, just pull the rug and not enable the banks to continue to support. As long as there's if there's a sort of a pathway out, and if they can see that it is a question of time, and ultimately that the company could become viable again and repay, but it just will take longer, then I would hope there would be some sort of sympathy to that. But inevitably there'll be others where some businesses just really, there is no light at the end of the tunnel, and maybe, some hard decisions will have to be taken.
Mm-hmm. Thank you, John. There is a question for Hans, which we can park for now, and we will ask him later on. There is a question about the government scheme for credit insurers and whether this will be extended. Well, in this case, there are a number of moving parts for the government and for the insurers, but particularly for the government, because the government is still, in some ways, dependent on the decision of the European Commission. And so what this means is that the government has to wait until the EU decides on what's going on in Germany or the Netherlands or other countries, sets a kind of pattern or the template of what they would like to see, and from there the UK government can raise a number of questions or make a number of proposals to the EU Commission, and then negotiate with insurers whether the scheme will be extended or not. Presumably the scheme will be extended. Under what form, that remains to be seen. And that's, of course, a bit shocking because we are at the end of November and the scheme ends at the end of December, so there's not much time. So we are trying to run parallel processes with our best options or best assumptions so that we can decide internally whether we will join that scheme or not, depending on what it looks like. And meanwhile, the government is doing its best to engage with the European authorities, get a feel for what they can accept, and from there we'll try to move as swiftly as possible. So with this, I would like to hand over to Hans and thank John. But of course, more questions can be asked to John later on.
Yep, thank you very much, and thanks, John, and thank you, Frédéric. John has already touched on the impact of Information Companies House and changes that have been made there, but I also wanted to look at the changes that have been made on the corporate insolvencies and the governance bill. What impact has this made for some of the claims and collections activities that we've undertaken? The government has implemented some temporary relief, which was up until September, which was relating to winding up petitions and wrongful trading. Winding up petitions and wrongful trading, I'll come back to that, but we've also got some permanent financial rescues and structuring strategies being put in place. One of those is the moratorium. Another one is for suppliers to continue to supply to businesses in financial distress. And there's also the ability to create a restructuring plan, which will bind creditors to this plan. So the statutory demands and the winding up, the statutory demands basically have stopped a creditor petitioning for a company that's in financial distress to be wound up, or at least to delay it. Now, this is not necessarily exactly true that this can be stopped. You can continue if you can prove and evidence that the financial distress was not coronavirus related and or was not, was already in place, so the company was already technically insolvent or had financial distress prior to coronavirus. They have now extended this till the 31st of December, and of course, this could well be extended into next year, as we are now entering in, or we are now full on in a second lockdown. To pursue that, it's going to be costly, so we would need to be careful and think about that. The other element is the wrongful trading. I will touch on that very briefly. Wrongful trading initially was stopped at the end of September. Basically, company directors who know that they are trading insolvent, know that they are therefore liable, personally liable, could have been pursued prior to coronavirus, were given some relief to see if they could come out of this, but this has now no longer been extended, so this is now back to normality. Moratoriums, basically moratorium was intended for a short period of time of 20 days to allow a business to trade through financial distress. Is there a restructuring plan that they could come up with that would allow them to come out at the other end? There were certain conditions. Although this is not insolvency, the actual insolvency petitioner is appointed, but he's appointed as a monitor. There's also the cessation of supplies. So in our case, should a policyholder continue to supply? A question has been asked many a times. During the moratorium, the company must continue to pay the debts, including newly incurred liabilities. So to stop supplies is basically, it could have an impact on the business, it could have an impact on their financial continuity, but for the same token, it could also cause financial distress to the policyholder. So the policyholder can request the courts to terminate this commitment. There's also the ability for an arrangement or a compromise with the creditors to be made, but at least 75% of the affected creditors in value need to vote in favor of this plan, and then the court can sanction this. Have these measures made any difference? John already mentioned that the 3-month filing extension in Companies House, that will continue up until April 2021. We don't know if that's going to be continued beyond that, but like John has also mentioned, the data that was being delayed was data that related prior to coronavirus. So as John has also mentioned, my team has also been actively looking out there to see if they can find alternative information, and invariably this was down to questionnaires being issued to some of the buyers, asking them how they have fared through coronavirus, what measures have they taken in place, and we're looking for more up-to-date information. But having said that, over the last sort of couple of months, we've seen a significant decrease in the notification of overdues. We've also seen the insolvencies, as John mentioned, drop, and it fell over by a third compared to September 2019. Very much unexpected. So John's mentioned it, are we in a zombie economy? Here's some of the insolvency statistics going back all the way back to the year 2000. We see in 2008, 2009 a sharp increase. We saw a little bit of a blip in 2017, but now we see completely the opposite. We see a huge drop now in the number of insolvencies. There's monumental amount of borrowing out there by the private sector, and this is going to take years to be repaid. There is something like 4.6 billion there of coronavirus large business interruption loan schemes, money that has been put on the table. 1.2 million smaller employers have access to 47 billion. All of their cash at some stage is going to have to be repaid. And at the moment, this is propping up the economy. And that is it for me. If there's any questions, I know there's a question on COVID impact reports that was asked on screen here. Do we utilize any of these COVID impact reports? I know some of the credit reference agencies have approached us. We're not directly utilizing them. We're actually using our own questionnaire to establish what impact coronavirus has had on that business, rather than to rely on mass formulas that have been issued by the CRAs. How effective do we find these reports? We haven't tested them, so therefore I couldn't comment on that. Any other questions?
There is a question linked to moratorium. Will the payments made to the policyholder post-moratorium be treated as salvage by Coface and therefore be deducted 100% from the pre-moratorium, i.e. insured debt?
Sorry, Frédéric, can you repeat that? That's an unusual question.
Yeah. Will the payments made to the policyholder after the post-moratorium be treated as salvage by Coface, i.e. will be deducted 100% from the pre-moratorium debt, which is insured?
I couldn't comment on that at the moment, to be honest, because we haven't had any of these scenarios. We haven't seen any businesses approach us with a moratorium in spite of what the government has put out. We have seen no cases of moratoriums being presented to us. As mentioned, the insolvencies have been absolutely minimal and decreasing, as have the NOAs, the notifications of overdue. So we have no experience, and I would say that at this present point in time, it would be a little bit dangerous to make a sweeping comment on moratorium and pre-moratorium payments.
Mm-hmm. There was another question which was raised a bit earlier, and I'm coming back to it. It was the ability to obtain cross-border financial information and whether Brexit would change anything to that.
There should not be any changes to cross-border information. It should still be readily available. It should still be readily available through our own offices as well.
If I can complete maybe the answer, there can be a change normally with GDPR, but of course we are normally not processing personal information when we are dealing with the analysis and the creditworthiness of companies. But nevertheless, even in the case of personal information, what is going to happen is that there will be a number of contracts between Coface UK, for instance, and the rest of the Coface countries within Europe, which means that we should be able to act as if we were still effectively within the EU in terms of the protection of data for our customers or the debtors to whom we speak.
Yeah, that's correct. Thank you.
Yeah, more questions can be raised to Hans. Don't hesitate. And with that, I would like to hand over to Andrew.
Good morning. Thank you, Frédéric. Good morning, everyone. You've been presented to by Hans and John, and desperate times lead to desperate measures, but also they lead to opportunity. So essentially, I'll go through a number of slides in respect to, how Coface has our duty to you as clients and partners and to those prospects to highlight just, a few scenarios in how you could be affected by fraud, and also what's happening from a fraud perspective at the moment. What does the landscape particularly look like? So fraud risk in itself is costing the UK an estimated 190 billion, but again, that is an estimation. It's most likely a lot more than that. Fraud actually goes vastly unreported because it might be small numbers that people just don't feel obliged to inform anyone particularly. The actual number of frauds or failed fraud attempts is going to be more than that. The public sector as well, so we've touched on government support, furlough schemes, and all the investment that the government is pumping into the economy. But of course, that's a massive opportunity to fraudsters themselves. So, the private sector, 140 billion, public sector may be losing 40 billion itself, and individuals around 7 billion. And we know consumer fraud is absolutely rife. Most frauds are reported to Action Fraud, and we as an insurer and a regulated business, we report fraud, and we suspect fraud, and all of those suspects, provided we have enough evidence, we would report those to Action Fraud, and we do see that quite regularly. And our feeling for and evidence for 2020 so far is that there is an increase in fraud attempts. Now, a lot of people might think that, fraud, it's not going to happen to me as a business. You may actually be a victim of fraud and not even realize it. Fraud can happen in a number of ways, just by an association. You as a business might take on board a customer, and they're not out to defraud you. They're out to defraud someone else through the supply chain. So don't think that you can't be a victim to fraud, because it can happen. And largely sometimes you're not even aware of it. Obviously, in these times, there are greater opportunities. We're moving more to an online platform, a virtual world, so to speak. And this is an absolutely massive opportunity to fraudsters. Fraudsters, in a large part are particularly sophisticated, and they will spend tens of thousands, if not more than that, in putting together a fraud. For them, it's around casting their net wide. Some fraudsters and some organisations can get a 1 in 10 hit rate, and obviously depending on the levels of fraud that they're taking, the goods that they might be obfuscating, we could be talking hundreds of thousands to millions of pounds worth of goods or services that will be taken, and they're becoming, like I say, very much more sophisticated. They're using artificial intelligence. It's now common, or certainly being prevalent now, that they will use the voice of a CEO They would take media clippings and they will use and analyze the voices, and they will replay them as they're speaking through the calls, and they will try and get into your, maybe your finance department and various other ways to try and sort of test you and to take on the identity of someone within your organisation. So even that is now being done, even from a video perspective. I'd sort of encourage you to go to YouTube and look at what's been done by some clever guys in the US on a fake Barack Obama. But all of this technology exists, and it's actually in play at the moment, and a lot of us don't realise that. So again, there's a lot of fraud being perpetrated. General consensus amongst the agencies are that COVID-19 itself is bringing the opportunity for fraudsters, and they're going to try their best to outwit us all. So let me move to some scenarios. Just going back to COVID-19, where are you sort of more at risk? Business owners, employers under greater financial pressure, fast tracking of new suppliers. So we're cutting corners potentially on processes. So you need to look at your KYC processes to mitigate. Operational efficiency drivers. If you're removing those, obviously you've got to think that protects your income, and so don't touch anything that is going to disrupt your supply chain and what you do. Capacity issues. Obviously, people are working harder, pushing things forward, and then others are taking the opportunity of the furlough schemes. So critical people may not be in your business or in your partner's business. Therefore, you need to understand that could have deep ramifications going forward. And again, desperation can lead to desperate measures across the business and internally with our employees as well. So some of the scenarios where we commonly see, and I've chosen a few here. So fraudsters set up a company with the intention of defrauding creditors. Buyers want to obtain illegitimate gain. That's the opportunity. The action, the buyer orders goods to a supplier with no intention to pay for them. Pretty obvious. And then the financial impact, creditor has to write off the debt or is insured by the insurer, and the insurer pays out. Again, caveat there that if you are insured, you need to make sure you were diligent in all of your processes and put things in place to mitigate risk. Business trading, so take over a legitimate business. This is what we pretty much see quite commonly as a long-term fraud. Order goods and pay promptly, place a large order, and then run. So a business can sort of be set up specifically to do that. And this is where we're talking about fraudsters investing, and again, a lot of money and time into setting these up. Collusion. So you may see this internally within your organization. So employees become financially desperate. Their partner may be on furlough or are no longer able to work. So the desperation. So, it's potential that, you could be defrauded from within. So it's always, worthwhile ensuring your processes are robust, and you have, level controls, particularly, where you think it matters. So it's always good to cast your eye on some of the processes internally, because obviously that can make a difference. Identity theft, this is something that we're seeing probably more common. In fact, I would say this is the most common that we see, where a fraudster pretends to be a known or unknown person from a company. They will slightly change the email addresses, and I've got some hints and tips for you at the end as a takeaway. The fraudster will order and redirect goods to another established area, industrial unit, something you've not may have seen before. So always double check, always try and mitigate that risk. Ask questions. Find another route to go back to the company on the numbers that you would and contact details that you normally would, in order to double check, because this is an area where, particularly as an insurer, we're unlikely to pay out in the event that you have not taken reasonable measures in order to know where those goods have gone. And then ultimately, some tips for you to take away. Again, fraud is very prevalent. There are a number of different ways that they will try. The hit rate is reasonably good from their perspective, so obviously we don't want you to become a victim. So here are a number of areas where you can take a little bit more diligence, take them on board, and ultimately use these and just reconsider what you do in your organisation to see how you can mitigate that risk going forward. Together, obviously, we can all do our part and play our part to reduce the level of fraud. It's going to cost the country enough as it is. Thank you. Any questions?
Yes, I think there are a number of questions. The first one, the obvious one, is how can Coface assist in identifying particularly multinational fraud, where there's a number of countries involved?
Absolutely, Frédéric. So one of the key things is obviously using our information. So the way Coface is organised is we're a very joined up organisation. So obviously we're looking at information, the strength and worthiness of businesses from a cross-border perspective, particularly those that are, multinational companies, etc. So we have a wealth of information, but also we sit on and observe all of the trade interdependent to each country. So, we already have those payment patterns established. When we're reviewing from an information perspective or a risk underwriting perspective, we can see that. It's the obvious things of trade sectors, making sure that does this make sense within the supply chain. So we're able to do that as much as we can through the analysis ourselves, and it's information that we and expertise that we do provide to our clients, whether they be insured or not.
Speaking of insurance, one of the follow-up questions is asking whether we have plans to extend the scope of our policies to cover fraud or to include fraud in the scope of cover.
It's a good question, but ultimately the issues you have in respect to that are that the recovery aspects for fraud are limited, if not impossible. So there's never any return or chance of return for an insurer. So premiums in order to provide that level of protection, in my view, would be not cost conducive. It's easier to spend money up front in mitigating the risk in the first place.
Mm-hmm. Maybe we've got a couple of other questions for you, Andrew, but maybe there was one question pending for Hans, which was about retention of title. Hans, would you take it?
Yes, the retention of title question. I'm just trying to call him back up again. Sorry, Frédéric, I lost that one here. Retention of title. Could you read that question out to me, please, Frédéric?
Yeah, basically, it's acknowledging the fact that the inability to enforce retention of title may lead to higher loss ratios and further consequences.
Yeah, it's a bit difficult, this one, because goods recovered on the ROT, if not recovered, would indeed increase the loss ratio. But then to adjust, we would need to know what the goods available are. I mean, it's one thing stating that there are goods available on the ROT. It's another thing, are they actually physically there? So there would need to be some evidence. Secondly, if these goods cannot be recovered on the ROT, then this is a discussion that needs to be had with the with Coface itself, as into what are the circumstances and how can we assist. Again, I wouldn't like to make a broad sweeping statement here, and I would like to consider this as an individual.
Mm-hmm. Thank you, Hans. Back to Andrew. There's a question about the fact that a number of, well, actually, it's both of you who can cover this. A number of agencies are promoting new anti-money laundering products to enhance KYCs and KYC processes. Are you, both of you, utilizing these products, or are we working on a similar product?
sorry, Andrew, maybe on the information side first. We are aware, and we have been looking at some of these reports. They are extremely expensive, and they are dark web related, some of these products. From an anti-money laundering point of view, they could be of interest, but this is more in hindsight. Is more once fraud has been established, then to maybe dig a bit deeper. If upfront we want to be using the AML, anti-money laundering reports, for example, where do you start and where do you stop? These are individual reports, and we're covering quite a large base.
I think also just to add that to do it justice in respect to a product, it would require a great deal of investment from our business. So we obviously do our own processes of know your customer, but that involves using a myriad of systems ourselves, but also common sense. We're information analysts within our business, so we use a lot of that information as well to reassure ourselves in respect to know your customer and prevention fraud. So we do a number of different things across our portfolio, across our risks, as part of the risk analyst's measure. But we don't at this stage have any desire to offer products in that space. Ultimately, we leave it to organisations who already have that expertise, and it's something that is built up over a number of years. There was also a question in regards to, does Coface have an international fraud network? Well, we do as a business. So the information we do share across countries. Any concerns, and obviously that plays a part in how we monitor risk. We're monitoring risk not just for financial purposes, but also we're monitoring from disruption, and disruption can include fraud.
Thank you, Andrew. That's another question which is not necessarily directly linked to fraud, but linked more to the constraints which our clients do have. And all budgets will be tight in 2021. So sadly, some of them may struggle to purchase insurance because it's still a discretionary spend. So the question mark is, do we have a product that can be, for instance, limit only, does not necessarily have the insurance coverage, but are we going to ramp up this type of product to offer something for clients to continue to monitor their risks, be they corporate risks, fraud risks, etc., etc.?
Yes, we do. So Coface has spent an inordinate amount of money and time, particularly in the last 12 months, to take and bring our sort of platforms into the 21st century from a digital perspective. So we're soon to be launching a new information platform. So currently our insured and information customers already, because we do have a global product, we're transforming a lot of that and the platform into a greater suite of products, which will be more honed to varying size of customer and their needs. So it is leveraging from Coface's intelligence and information globally. So, as people may know, we have tens of thousands of clients worldwide, and then you multiply that by the 2.5 million buyers that we're monitoring at any one point in time. So all of that information and intelligence has now been brought to the fore into a new suite of products. So it is something that, it goes one step above in respect to information diligence, and to help and guide clients who, again, yes, if they can't afford credit insurance premium, but they're still looking to leverage from an insurer's viewpoint, then that there is a product there that we can provide them with.
And we will definitely continue to invest in that space, because we do believe, in the same way as you, that there is a lot of value in bringing not just the insurance product, but the information for the benefit of our clients and our partners.
Absolutely, and it can also be complementary to those who currently insure, whether it be a different market or different business line. But also, we have clients who use our information for their supply chain. Again, don't just think about the receivables themselves. Think about the disruption to your business if one of your suppliers. COVID is a very good example as to how companies have actually been disrupted by pretty much no fault of their own. It's their suppliers who, are not able to have been in production, so there's a backlog. All of that, component-wise, ingredient-wise, whatever it may be, or service-wise, is disrupting people's business. They think they're not affected, but what we've seen, particularly, is that companies are affected. So using and looking, up to the supply chain and ultimately wider than that, secondary, tertiary, some organisations have now decided that that's a prudent thing to do.
All right. I think we have dealt with most questions. Is there anything further you would like to mention, Hans, John, Andrew?
I think another question has come in relation to Companies House and the tightening up of to go through a proper vetting process. I know that there's been a couple of government instances and departments that have been looking at Companies House, have been looking at interviewing Companies House, asking them to tighten up on their publication of reports and companies, submitting reports into Companies House. Companies House is still widely viewed as an archive rather than as a vetting place where the papers are properly vetted. Yes, it would help enormously if that was tightened up. Are they going to do that at the moment? I am not sure. Coface is looking at it, and I know our analysts have this year made some distinctions between the various different reports that have been filed. We have seen an increase in the number of reports being filed in Companies House that have changed from audited to unaudited. We see more abridged, more filleted, and a variety of these accounts being filed. And a lot of these do need to be very carefully monitored, but Companies House, unfortunately, is not that entity that monitors these reports. So it's something that we are doing. And as Andrew mentioned, it's part of our EIC products as well, that we take that sort of report into consideration with our ratings.
I think from a fraud perspective, everyone's running around at 100 miles an hour at the moment. And, that is going to continue for some time to come. So it's really just about, pausing for a moment, checking processes, checking what you do as a business, doing a 360 ultimately, something that may take, just a moment of your time. For some organisations, a bit more of that. And probably a lot of companies are already doing it. But it's always good to just take a moment, and really see what's going on and think about, I can be a victim of fraud. Do I feel comfortable that I'm making the necessary measures and mitigating those risks, essentially? What more do I need in order to do more? So, obviously we're available to help guide on that.
Thank you very much, Andrew. Thank you very much, Hans. Thank you very much, John. I think we are coming to the end of this webinar. Thanks to all who have joined us today. I hope you did find it interesting. The slides will be made available. So if you have further questions, please don't hesitate to send those questions, and we'll try to answer them as best as we can. And meanwhile, I hope you continue the dialogue with Coface and you enjoy the support which we provide, the information, the guidance, as much as we can, again, in this very turbulent environment. And we look forward to making a success of 2021 together, whatever is in store for us. So thanks again, and I wish you a very good day.
Thank you all.
Thank you, everybody.
Thanks and bye.